Economic perspectives are obviously affected by lots of economic factors, but also by non-economic factors. One of them is the coronavirus. In recent weeks, the global economic outlook was threatened by this coronavirus that started in China, and more precisely in the city of Wuhan, which can be considered as the industrial heart of China, mainland China. Now, lots of observers are afraid that this coronavirus may have an impact not only on the Chinese economy, but also on the global economy, because China obviously is very strongly integrated into this global economy. Now, today we are not so much afraid about long-term economic consequences of this coronavirus. Rather, we see it as a temporary economic shock, which will have obviously an impact on the Chinese economy, and we will see that also in the annual growth figure for China, but we don't expect a major impact on the European or the US economy. So therefore, we do believe that the coronavirus is of course an important source of volatility, as we have seen in financial markets. And we see the sensitivity, for example, in the bond market with long-term rates going down again, as well as oil prices going down. But generally speaking, we expect that the coronavirus will only have a temporary impact. In terms of new economic numbers, we now have growth data for the European economies in the fourth quarter of 2019. Generally speaking, for the euro area, these figures confirm our scenario. The European economy is clearly stabilizing and probably is going to recover in 2020. Now, if you look at individual European countries, there we see that the picture is far from being homogeneous. Some European economies did very well in the fourth quarter. For example, Spain did very well, also Belgium did quite well, while other countries didn't do very well, in particular France and Italy. In Italy, we had a very substantial growth decline in the fourth quarter, which can be explained by the political uncertain situation, as well as by the consequences of the economic slowdown elsewhere in Europe in the middle of 2019. Now, the most important figure was definitely for Germany, and the German economy clearly recovered again in the fourth quarter, bringing German economic growth for the entire year to 0.6%, which is obviously lower than in previous years, but which is still quite okay for a rather weak economic year. Now, recovery in Germany is obviously important for the entire European economy, and therefore this is really good news. Still, we see that there are challenges in the German economy. For example, industrial production is still shrinking, but also forward-looking indicators are again becoming much more positive. So therefore, despite the mixed signals, we are quite confident that 2020 will become a year of general economic recovery in Europe. Also, the US economy did quite well in the fourth quarter. The US economy, which is in a late cyclical phases, did equally well in the fourth quarter as in the third quarter, and that's actually quite good news. So stable growth is a signal of strength in the American economy, continued strength, despite the fact that there are obviously challenges around the US economy, not at least the trade tensions because of the US-China trade war. Now, generally speaking, we see that US growth has different dynamics than in previous quarters. We see that investments as well as consumption is contributing less to growth than we would expect for the US economy. So this is clearly a signal, let's say, that the US economic cycle is indeed slowing down. Now, generally speaking, the US labor market is doing very well again. There is strong job creation. At the same time, also wage growth is increasing. And those two factors are likely to support consumption growth going forward. And that's obviously good news. So we confirm our belief that the US economy can still have a very nice economic year. Together with higher growth rates, we also observe higher inflation. Now, inflation is partly driven by economic dynamics, and we see that in the US as well as in the euro area. But at the same time, we see that the core inflation in the euro area is coming down again to 1.1%, which is, let's say, the long-term average. Now, this basically implies that we are still far away from the ECB as well as the Federal Reserve's target of inflation. So therefore, we don't expect any further changes in monetary policy. Rather, we expect a quite constant monetary policy for the period ahead. That doesn't mean that monetary policy is not changing in other places in the world. For example, in Europe, a notable exception was the Czech National Bank that decided to increase quite unexpectedly interest rates from 2 to 2.25%. Maybe, well, it could be considered as a front runner for the normalization process that we still expect for the ECB in the longer run. To summarize, we can say that the global economy is still in a pretty good shape. with stabilizing and even higher growth, and we do expect that 2020 will be a year of general economic recovery for the advanced economies in particular. Now, of course, there are always distorting factors, and the coronavirus will be one of them, but we don't believe that this virus will have a long-lasting impact on the global economy.